All right, let's start with a number that, frankly, just doesn't add up. 172 billion Turkish lira.
Huge.
That's the revenue we're looking at today.
Yeah.
It's a massive number. It's actually up from the previous year. You see that top line, you think, okay, business is booming.
It's the kind of number that usually gets the champagne corks popping in the boardroom. A staggering amount of business.
Usually. But then you scroll down to the bottom line and, well, the champagne turns to vinegar.
Mm-hmm.
Because despite moving 172 billion lira worth of product, they didn't make a profit. They posted a net loss of 380 million lira.
And that's the contradiction we're digging into today. How does Turkey's, undisputed heavyweight champion of pharmaceutical distribution...
A company with almost 40% market share.
Exactly. How does it lose money while growing its revenue?
That is the mission for this deep dive.
Yeah.
We are stripping down the 2025 annual activity report of Selçuk Ecza. We're going to look at the mechanics of this loss, the family dynamics running the show, and what it tells us about the broken economics of logistics in a high-inflation world.
And just to be clear on the source material, we are working strictly from the official audited Fallait Raporu, the activity report for 2025.
Right.
All the figures we're quoting are in Turkish lira, and we're looking at this from the perspective of a retail investor trying to figure out if this giant is stumbling or maybe just crouching.
Let's first get to know the company a little, because Selçuk Ecza sounds like it could be a local depot, but the physical footprint here is just... it's absolutely massive.
It's pure infrastructure. I think that's the best way to frame it. They aren't the makers, they're the movers.
They don't press the pills.
No, they don't mix the chemicals. They take the drugs from the manufacturers and get them onto the pharmacy shelves. And to do that for a country the size of Turkey, they're operating 110 warehouses.
110, and that's split, right, between main hubs and smaller ones.
Yeah, 27 main centers and then 83 regional ones. And to service all that, they have a fleet of nearly 2,400 vehicles.
Wow.
2,383 to be exact.
Okay.
And that is such a critical data point. Think about it. All those vehicles on the road every single day.
Fuel costs, maintenance.
Driver salaries, all in an inflationary economy. That fleet is as much a liability as it is an asset.
And all that is to service 27,000 pharmacies.
Out of roughly 30,000 in the entire country.
So we're talking about, what, 90% penetration?
Pretty much. If you walk into a pharmacy anywhere, there's a very high chance the medicine on that shelf came off a Selçuk truck.
Their market share is 37.6% by value. By box count, it's even a little higher, near 38%.
This is what you'd call a classic mode. It's not a business you can disrupt with an app.
Right.
You'd have to buy 2,000 trucks and build 100 warehouses just to get a seat at the table.
So, okay, their position is ironclad. They've got a great credit rating, the network, the market share. But let's go back to that financial train wreck.
Yeah.
In 2024, they made a 2.7 billion lira profit. In 2025, a 380 million lira loss. That's a swing of over 3 billion lira in the wrong direction. What on earth happened?
It's the scissors effect. And to get it, you really have to understand how drug pricing works in this market. This isn't a free-for-all where Selçuk can just raise prices because diesel got more expensive.
Right, I saw that. Their margins are regulated by the state.
Correct. The depot sale price is fixed by government decree, so picture one blade of the scissors as your costs.
Fuel, electricity for 110 warehouses, people.
Exactly. In 2025, those costs shot up with inflation, skyrocketed, but the other blade of the scissors, the price they can charge, is stuck.
It's fixed.
The government does update the price bands, but there's always a lag. If inflation is running hot and the price update comes 6 months late, or it's just too low, your margin gets absolutely crushed.
So you're basically subsidizing the distribution of medicine.
For a time, yes. The report even uses the phrase erosion of margins. They do mention a potential fix, a presidential decree that helps, but it's a lagging fix.
And by then, the damage for the quarter is done.
The loss is already booked. And we have to mention the accounting itself. The report notes the application of inflation accounting, TFRS.
Which can make things look even more stark.
It strips away any illusion of nominal growth. I mean, if your revenue is up 20% but inflation is 40%, you've actually shrunk in real terms.
Yeah.
That 380 million loss is the cold, hard reality of your purchasing power just vanishing.
Now let's take a closer look at what management is telling us. They see the red ink, obviously. So what's the strategy? Are they panicking?
Not at all. The tone is, I'd say, realistic, almost stoic. They
Yeah.
acknowledge the networking capital challenge, and their strategy is all about operational efficiency.
Okay.
You can see it in the headcount. They went from over 6,100 employees down to just under 6,000.
So a reduction of almost 200 people.
Exactly. They're tightening the belt, optimizing fleet routes, but they're not, pivoting the whole business model. They know they are the pipeline. They're just banking on the regulatory side to eventually catch up.
And even with the loss, they didn't stop spending. I noticed they added about 76 million lira to their land assets.
Bringing that portfolio to over 2.1 billion, that's a classic Turkish hedge against inflation. When operations are squeezed, you buy dirt, land holds its value.
But no R&D.
Zero. The report is blunt about it. No R&D activities. And you know what? I kind of respect the honesty. They aren't pretending to be a biotech firm. They're a logistics company. Their investment is in IT to track the trucks, not to invent molecules.
Okay, let's talk risks. If I'm looking at this purely from a risk perspective, regulatory risk has to be number one.
It is number 1, 2, and 3. Their entire gross profit is determined by those government price bands. If the state doesn't raise them, the company suffocates. It's completely out of their hands.
What about financial risk? They lost money. Are they close to broke?
No, not at all. They have a very strong cash buffer. About 2.95 billion lira in cash and cash equivalents.
That's a decent safety net.
It is. But you have to remember, this is a cash-hungry business. They have to buy all the drugs first before they sell them. They have short-term liabilities around 670 million lira. So while they have cash now, you can't keep running at a loss forever. That pile will shrink.
Let's pivot to who actually owns this machine. Because if I go buy a share of Selcuk on the exchange, I'm technically an owner. But reading the governance section, I'm not really an owner, am I?
You're a passenger. This is a family affair dressed up as a public company. About 77% is held by the Selçuk Ecza holding, which all traces back to the Kilishulu family and their foundation. The free float, the part you and I can buy, is just 20%.
But it's worse than that. It's the voting rights.
The Class A versus Class B split. This is so vital for anyone listening. The family holds the Class A shares, the public holds Class B.
And the math on that is?
One Class A share gets 10 votes, one Class B share gets 1 vote.
So my voice is mathematically 1/10 as important as theirs per share.
And it gets even more direct. The board of directors has 9 seats. The Class A shareholders, the family get to pick 6 of them directly. No one else gets a say.
So the game is locked. A minority shareholder has literally no path to influencing strategy.
0. You're just betting on the jockey. And speaking of the jockeys, the board is led by M. Sone Gergen. He's both the chairman and the general manager.
Which is a governance red flag in a lot of Western markets. You're supposed to split those roles.
Here, it's consolidated. And looking at the board's composition, it's a very homogenous group.
You mean it's all men?
As of the 2025 report, yes. The names listed are all male. Now, they do have a stated target to reach 25% female representation by 2030, but for now, that's still just an item on a future to-do list.
Okay, speaking of family dynamics, let's look at the related party transactions. This is always the section in the footnotes where you find the most interesting stuff.
The family ecosystem, I call it. This is where that governance structure really matters. Selçuk Ecza, the public company, does a huge amount of business with other private companies owned by the same family.
I saw the numbers for Menarini. That's the pharmaceutical manufacturer, right?
Right. And the chairman of Selçuk Ecza is also the chairman of Menarini's Turkish arm. In 2025, the public company bought nearly 3 billion lira worth of drugs from them.
3 billion. That's a massive chunk of their inventory coming from a related company.
And it's on the expense side, too. They paid 280 million lira to Selçuklu Tourism Vainshot, the family construction business, to build warehouses.
So the family construction company builds the warehouse and charges the public company. The family pharma company sells drugs to the public company. And the public company takes on all the risk of distribution.
Now, to be fair, the report says these are all at market rates. And that may be true, but when you see billions flowing between entities controlled by the same small group, you have to really trust that those market rates are being checked.
Because if they're not, it's very easy for value to leak out of the public company.
Especially when that public company is posting a net loss, those outflows suddenly get a lot more scrutiny.
Speaking of outflows, what about dividends? I saw they paid one in 2025.
They did, about 248 million lira in total. But the key thing to remember is that dividends are paid out of the previous year's profits. That payout was from the 2024 bonanza year.
So looking ahead to 2026.
You can't pay dividends from a loss. Unless they dip into some extraordinary reserves, the math for a dividend next year looks terrible. If you're an income investor holding this for the yield, that 2025 net loss is a huge warning sign.
All right, let's do a quick SWOT analysis to sort of pull all this together. Strengths.
Unmatched scale. The 110 warehouses, 38% market share. It's a logistical fortress. You just can't replicate it.
Weaknesses.
Paper-thin margins and huge working capital needs, and they're totally vulnerable to inflation because they can't set their own prices. Efficiency. Digital transformation. If they can use data to cut fuel use by just 5%, that's a huge win. And, of course, a change in government regulation.
The big threat.
Government pricing decrees. It's the sword of Damocles hanging over the entire business model.
One last thing. What about the ESG angle? They're running 2,400 diesel trucks. Are they doing anything on that front?
They are. They're making a move into solar with GES projects. They generated about 764 megawatt hours in 2025.
Is that significant for a company this size?
It saved about 338 tons of CO2. It's nice. It lowers the electricity bill. But let's be real, compared to the emissions from 2,400 trucks driving all over Turkey every day, it's a drop in the ocean.
And there was a specific certification I noticed was missing.
ISO 14001, the Environmental Management System certification. The report admits they don't have it yet. For a company with this kind of revenue in 2025, not having a standard like that suggests sustainability is more of a side project than a core strategy.
So, bringing this all together, we have a company that is operationally indispensable. You cannot run the Turkish healthcare system without them.
It's too big to fail, in a literal supply chain sense.
But financially, at this moment, it is a losing proposition.
It's a bet on regulation. If you buy this stock, you aren't betting on management's skill to sell more drugs. They already sell to everyone. You're betting that the government will widen the profit bands to account for inflation.
You're betting on the stroke of a pen in a ministry office.
While also accepting you have no voting power whatsoever.
It's a tough trade. It really challenges that idea that market leaders are always safe havens.
Absolutely. In a high inflation world, being the biggest just means you have the highest fixed costs. If the pricing mechanism breaks, the Goliath can starve faster than the David.
And that's the thought I want to leave everyone with. We see market share as this ultimate prize. But if 40% of the market results in a 380 million lira loss, maybe the traditional distribution model itself is broken.
It's the multi-billion lira question, isn't it? If they can't make money moving drugs, who can?
And that is a wrap on Selçuk Ecza. We've unpacked the 2025 report, the loss, the family control, and the risks. Just a reminder, this deep dive is for informational purposes only. We're just reading the map. You have to drive the car.
Always do your own due diligence.
If you got value out of this deep dive, please hit that subscribe button. Like the episode, share it, and if you really want to support the show, check out the Super Thanks feature. It helps us keep the lights on and the deep dives coming.
Thanks for listening.
Catch you on the next one.